Hey everyone, and welcome to this explainer. Today, we're literally pulling back the curtain on the hidden mechanical gears that secretly drive the stock market. So just forget the news headlines and earnings reports for a second. We're going to dive into the invisible market machine that operates just under the surface, dictating how your stocks actually move day in and day out. Have you ever just sat back and watched the market suddenly melt up or completely crash on absolutely zero fundamental news? Everyday investors see this all the time, and we're just left scratching our heads. You might think, wow, someone somewhere knows a secret. But actually, scratch that. It's often not a secret at all. It's actually driven by an invisible machine, powered by pure, unfeeling market mechanics. So to start, let's go to Section 1, Meet the Mechanics, the market makers. Okay, so to really understand this giant machine, we have to look behind the scenes. When you open up your brokerage app and buy a stock option, there usually isn't another everyday retail investor sitting in their living room perfectly timing the exact opposite trade. Nope. Instead, an entity called a market maker steps in. They take the other side of your trade just to provide liquidity. And we have to realize that these options dealers are not Wall Street gamblers. Not at all. They're incredibly risk-averse. Think of them kind of like an insurance provider or a casino house. They make their money simply on the tiny difference between the buy and sell price, the spread. Because of that, they absolutely must stay neutral. They literally don't care if the stock goes up or down. So here is the absolute crucial point. When you buy a call option, the market maker who sold it to you is suddenly holding a bet that the stock will go down. Boom, they're exposed to risk. So to strip out that directional risk and balance their books, the dealer is forced to buy shares of the underlying stock. They create a perfect hedge. If the stock goes up, sure, they lose on the option, but they win on the stock they just bought. It's a flawless balancing act. Let's move on to Section 2, translating the Greeks, speed and acceleration. Now, this mechanical hedging is governed by two totally complex-sounding financial terms, delta and gamma, which are often called the Greeks. But honestly, if you've ever driven a car, you can understand them in basic layman terms. Think of delta simply as the speed of your car. It tells you how fast your option's price is moving relative to the stock. Gamma, on the other hand, is your acceleration. It tells the dealer exactly how fast their speed, their delta, is changing. If you slam on the gas, your speed changes rapidly, right? Well, high gamma means the dealer's risk is changing incredibly fast, forcing them to frantically buy or sell stock just to keep their car driving in a straight line. Let's look at a super simple example of delta in action. Options contracts are typically bundled in 100 shares. So say you buy a call option with a delta of 0.50. The dealer is immediately exposed. To stay perfectly balanced, they multiply that 0.50 by 100, and they act immediately to buy roughly 50 shares of the underlying stock. They aren't buying those 50 shares because they love the company, they're buying them purely because the math tells them to. All right, Section 3, the market thermostat. So what happens when millions of these trades from millions of investors pile up all at once across the entire stock market? Well, gamma starts to act exactly like a thermostat in your house. When dealers are in what we call a positive gamma regime, they act as the market stabilizer. If the market drops, their mechanical hedging forces them to buy. If it rallies, they sell. It's exactly like the air conditioning kicking on when it gets too hot. It cools the market down and keeps prices trapped in a nice, tight, quiet range. But when the market slips into a negative gamma regime, oh boy, the thermostat completely breaks. Dealers are forced to sell when the market drops and buy when it rallies. This blasts the heat, amplifies volatility, and fuels those absolutely wild, erratic price swings we always see on the news. Now, the exact price level where the market transitions between these two states is called the gamma flip point, and it is heavily watched by institutional traders. Why? Because once the stock price breaks below this line, the market goes from a calm, stabilizing environment right into a volatile, amplifying one. The mechanical selling or buying from dealers can just suddenly accelerate out of nowhere. It's the exact boundary where the market stops taking the stairs up and literally starts taking the elevator down. Okay, Section 4, anatomy of a gamma squeeze. Let's look at what happens when this invisible machine completely breaks down and goes into absolute overdrive. This maps out the famous gamma squeeze feedback loop. We saw this briefly with GameStop back in early 2021. Here's the process in super simple terms. Step 1. A massive swarm of retail traders buys call options. Step 2, the market makers take the other side. Step 3, to hedge their massive new risk, dealers are forced to aggressively buy the stock. Step 4, because dealers are buying so much stock, the price goes up. But here is the crazy kicker. As the price goes up, the acceleration, the gamma, forces the dealers to buy even more stock just to still balanced. This creates a forced, self-reinforcing buying loop that pushes prices way, way beyond a company's fundamental value. Now, people often confuse this with a short squeeze, but they are mechanically totally different. It is absolutely vital to note that a gamma squeeze relies entirely on the options market mechanics and dealer hedging we just talked about. This means a gamma squeeze can happen even if a stock has absolutely zero short interest. No way, right? But it's true. A short squeeze requires short sellers being forced to cover. A gamma squeeze simply requires aggressive options buying that forces computer algorithms to blindly buy the stock. Which brings us to Section 5, spotting the invisible hand. Now that we know how it works, how can everyday investors actually spot these forces out in the wild? Well, what's really interesting here is that these aren't just crazy internet theories cooked up on a message board. Academic research, like this study from Singapore Management University, mathematically proves that these mechanical dealer hedges create massive intraday liquidity vacuums and have undeniable impacts on the stock market. When market makers need to hedge, they demand liquidity, and that physically moves the underlying stock prices, totally disconnected from how the actual business is performing. So, how do we survive the machine? Here are a few simple, actionable ways to anticipate this erratic stock behavior without needing a degree in quantitative finance. First off, expect exaggerated price moves near big round numbers where a lot of options sit. Second, if you see the VIX, that's the volatility index, falling while the market is rising, watch out. That actually changes the math for dealers and can force them to blindly buy more stock, fueling a quiet rally. Finally, always pay close attention during options expiration weeks. That's usually the third week of the month when millions of these contracts just disappear, forcing dealers to aggressively readjust their scales. So, as we wrap up this explainer, I really want to leave you with this one thought. The next time the market drops abruptly or rockets to the moon on completely zero news, you have to ask yourself a new question. Are investors really reacting to the economy, or are the invisible, robotic hands of the options market the ones actually steering your 401k? Once you see the machine, you'll never look at the stock market the same way again. Thanks for joining me for this explainer. Keep asking questions and keep learning.